Now speaking, John Hulbert, Vice President, Investor Relations. In our first quarter 2023 earnings conference call, Brian Cornell, Chair and CEO, Christina Hennington, Chief Growth Officer, John Mulligan, COO, and Michael Fiddlek, CFO, provided insight on our Q1 performance, outlook and priorities for Q2 and beyond. We have investors and others who are joining us via webcast and will be available to answer follow-up questions after the call. Our forward-looking statements are subject to risks and uncertainties, including those in our most recently filed 10. Now speaking, Brian Cornell, Chairman and Chief Executive Officer. In Q1 of 2021, Target's total sales increased 0.5%. Profitability also exceeded expectations due to their team's discipline and dedication. They experienced 3 consecutive years of traffic growth, with comparable traffic increasing 0.9% in the first quarter. 97% of sales were fulfilled by stores, and same-day services expanded more than 5%. Despite consumer caution, Target maintained a conservative inventory position. Shrink and organized retail crime are causing headwinds, reducing profitability by more than $500 million compared to last year. The company is investing in wages and benefits, as well as foundational learning for their team. Now speaking, Christina Hennington, Executive Vice President, Chief Growth Officer. In Q1, Target faced elevated volatility and reprioritization of spending away from discretionary categories due to persistent inflation. Despite the near-term challenges, guests continued to trust Target and shop more often. Comparable sales were flat to last year, driven by mid-teens growth in beauty, high single-digit growth in food and beverage, and low single-digit growth in household essentials. Apparel, home, and hardlines experienced sales declines in the mid-single digits to low double digits as guests pulled back on discretionary purchases. However, seasonal moments and newness in these categories saw great response from guests. To create collective value, Target used Roundel and Target Circle promotions to increase trips and spending. Guests responded to Target's own brands for their quality and price, with Cat and Jack offering items such as $4 t-shirts, $5 leggings, and $8 dresses and jeans, all backed by a 1-year guarantee. This summer, Target will continue to focus on newness and value, helping guests celebrate key summer moments with food and beverage offerings, vibrant apparel color palettes, movie blockbusters, and the latest Tabitha Brown assortment. Now speaking, John Mulligan, Executive Vice President, Chief Operating Officer. Over the last 3 years, teams throughout our operations have done an amazing job adapting to rapid and unexpected changes. This year, we are focusing on training and development for our team, as well as assessments centered on essential store operations. We're investing in a cohort-based peer learning model to develop our store supervisors and leaders, and our Dream to Be program provides tuition-free education options for U.S.-based part-time and full-time team members. We ended the first quarter of 2021 with 16% less inventory than a year ago, while making strategic investments where we believe we have a long-term market share opportunity. In terms of our supply chain, we are working to modernize how we replenish inventory in our stores, reduce labor demands on our store team members, and roll out automation. Our sortation centers use technology and process logic to sort packages and provide a faster and better guest experience. Additionally, we are testing high-capacity van routes and shifting more routes to larger passenger vehicles in order to increase the number of packages that can be delivered per hour. All of these efforts are designed to help our guests discover the joy of everyday life. Now speaking, Michael Fiddlek, Executive Vice President, Chief Financial Officer. In the last 3 years, the U.S. unemployment rate has dropped to its lowest level in 50 years. While inflation has risen to decades-high levels and the Federal Reserve has been raising interest rates at an unprecedented pace. Despite these macroeconomic pressures, consumer spending patterns are continuing to evolve, driving a 0.5% increase in total sales in Q1 of 2021 compared to 2019, along with 43% growth in total sales since then. Gross margin rate increased by 60 basis points in Q1 due to lower freight and transportation costs and strong expense discipline across the company. However, shrink reduced the gross margin rate by 1%, resulting in an operating income rate of 5.2%. In terms of capital deployment, CapEx for 2021 is estimated to be between $4 to $5 billion, dividends paid were up 20%, and no shares were repurchased in Q1. For Q2, sales are expected to decline low single digits, and GAAP and adjusted EPS range from $1.30 to $1.70. The full-year guidance is for flat comparable sales, $1 billion plus in operating income growth, and GAAP and adjusted EPS of $7.75 to $8.75. Now speaking, Brian Cornell, Chairman and Chief Executive Officer. Target is focusing on the long-term needs of their guests, investing in stores, supply chain, digital fulfillment, and team. Following the onset of the pandemic, they saw unprecedented traffic and sales growth in discretionary categories and grew traffic by just under 1% in the first quarter as guests increased spending in beauty, food and beverage, and household essentials. They have seen double-digit growth in beauty sales for the last 3 years and mid-teen growth in the first quarter. They are committed to bringing affordable joy to their guests and deepening their long-term relationship. Wells Fargo Securities analyst Edward Kelly inquired, have you taken into account increasing consumer pressure in Q2 when reaffirming your full-year guidance, and is it realistic to expect a back-half improvement of the low $2 range? Brian Cornell replied, Michael discussed Q2 results, which included a 5% revenue increase and 7% profit growth. He then highlighted our plans for. Michael Fiddlek replied, we continue to take a cautious approach to the top line, which helped us achieve a profitable outcome in Q1. This posture will affect our top and bottom lines, with shrink pressure impacting the first half of the year and efficiency initiatives providing benefits in the second half. We are cautiously optimistic for the full-year positioning. Brian Cornell replied, I heard Christina talking about the changes in inventory that will benefit us for the rest of the year, giving us optimism. We have reduced inventory allowances and are stocking items that we know customers want. This has led to 12 consecutive quarters of increased traffic. We are also doing well with food, household items and beauty. We are confident in our plans for back to school and the holiday season. Wells Fargo Securities analyst Edward Kelly inquired, at the Investor Day, you mentioned that 6% was a potential for 2024. With the changing macroeconomic landscape, can you give an update on your thoughts on the building blocks to reach this 6% target? Michael Fiddlek replied, we are at the end of Q1 2021 with our performance meeting expectations and our full-year guidance still applicable. We plan to build back profitability by 2023, which will be the first step in the process. J.P. Morgan Chase & Company analyst Chris Horvers inquired, have I understood correctly that despite disinflation in consumables, the introduction of newness and easier compares in the second half of the year will lead to a reduced decrease in general merchandise performance? Christina Hennington replied, we anticipate volatility but expect Target's strengths to be amplified in the second half of the year. Starting with back to school, we can leverage our 5 categories, multi-category portfolio, to provide families with backpacks, lunches and new outfits. We will introduce new fashion trends in September followed by Halloween and Thanksgiving/Christmas, which are big moments for Target. Additionally, we believe there is market share upside in home, benefiting from disruptions in domestics and kitchen appliances. We expect this to be supported by having the right. Michael Fiddlek replied, I have been managing inventory cautiously, which has given me the flexibility to react quickly in light of current conditions. In the quarter, my inventory decreased by 16% year-over-year, with discretionary categories decreasing by 25%. This gives me a lot of room to maneuver as I move into the latter part of the year. J.P. Morgan Chase & Company analyst Chris Horvers inquired, have I understood correctly that the impact of shrinkage is expected to dissipate and freight expenses are projected to improve in the second half of the year? How are efficiency efforts proceeding and how will they affect the P&L? Michael Fiddlek replied, we are pleased to see improved freight performance year-over-year and anticipate continued improvement as the year progresses. Our efficiency initiatives, such as our sortation centers, are providing benefits this year and will continue to do so in the coming years. We now have many more sortation centers operational and they are helping us save costs in last-mile shipping with our ship drivers. UBS analyst Michael Lasser inquired, can you confirm that the 150 basis point drag in gross margin from 2019 to 2023 was mainly due to shrink? Michael Fiddlek replied, I saw a year-over-year tailwind from freight and markdown, as well as a headwind from shrink in the first quarter. Shrink was a full percentage point which would result in a front half of the year drag if current trends continue. UBS analyst Michael Lasser inquired, are you willing to sacrifice profitability to maintain top-line performance in the second half of the year and beyond? Michael Fiddlek replied, we saw strength in traffic during Q1 with balanced categories, and our guide for the year has remained unchanged. We believe our view on the top and bottom line is appropriate based on the variables from one quarter into the year. Christina Hennington replied, I agree with Michael that we are not willing to make trade-offs. We are looking to take share from the market due to our unique proposition. We have a conservative approach in discretionary categories, but the majority of traffic gains are coming from the guests choosing food, beverage, household essentials and beauty. We are seeing price inflation and sensitivity in these categories which shows the relevance we have created. We will focus on newness, affordable joy and areas where the guest finds our value proposition relevant, which showed up. Brian Cornell replied, Michael, I have a strong feeling that our multi-category portfolio will help us succeed in 2023. With a balance of national brands and own brands, we are able to provide our guests with affordable joy. Our inventory has been reduced to give us flexibility to flow fresh, new items that meet the demands of our guests. Credit Suisse analyst Karen Short inquired, have you seen a misperception of your price points and value proposition leading to weakness in discretionary sales? Additionally, what sort of losses have resulted from the measures taken to address shrinkage issues? Brian Cornell replied, Target is working with the National Retail Federation, NRF, Retail Industry Leaders Association, RILA, and other retailers to advocate for public policy changes to address theft and organized retail crime. This issue has been an urgent one for the entire retail industry, impacting product availability, shopping conditions and safety. Despite a decline in apparel sales in the industry, Target has continued to bring fresh, new items at great price points in categories such as home and hardline related, holding a growing share in these soft markets. Christina Hennington replied, we have been discussing unit share for multiple quarters due to affordability and it has helped contribute to traffic gains. Our value proposition is expect more, pay less and we are leaning into our loyalty program, Target Circle, which offers personalized promotions with better returns than mass promotions. Own brands also play a key role in delivering value through great quality and accessibility from a price point perspective. Oppenheimer and Company analyst Rupesh Parikh inquired, do you anticipate a more promotional backdrop for Q2 compared to what you have seen in the current promotional backdrop? Christina Hennington replied, guests are actively looking for deals, with the goal of balancing their budget. We want to offer competitive deals while making sure they are personalized. Our inventory position allows us to compete without having to lower our prices significantly, giving us an agile playbook to create relevance and value. Oppenheimer and Company analyst Rupesh Parikh inquired, do you feel that the $1 billion plus headwind and shrink over the 2-year period can be fully recovered, and are you seeing any positive traction with the efforts in place to do so? Brian Cornell replied, I implemented mitigation efforts in 2020 to reduce the environmental impact of our company. This included installing. John Mulligan replied, we are taking multiple approaches to creating a safe environment for our team and guests which has a financial impact. Last year, we implemented some security changes in the store resulting in improved safety, increased sales, and reduced out of stocks. Our goal is to create an environment with minimal friction for our guests. Morgan Stanley analyst Simeon Gutman inquired, thanks, Brian. Can you provide perspective on how competitive the consumer market is compared to last year and pre-COVID? Brian Cornell replied, year on year, Target has seen consistent trends in its 3 major discretionary categories, apparel, home, and hardlines, generating $55 billion in revenue in 2020. Despite the competitive market, Target is leveraging Target Circle and its own brands to provide great value for its customers. As a result, Target is looking forward to capturing opportunities in the back-to-college and holiday seasons. Morgan Stanley analyst Simeon Gutman inquired, did Q2's negative flow-through exceed that of Q1, and why wasn't there more margin recovery in Q2 despite the potential for a negative comparison? Michael Fiddlek replied, I am expecting to be conservatively positioned in the top line and plan for a slightly negative comp in the second quarter due to an inflationary cost environment. There will also be a headwind of shrink in the first half of the year that we are monitoring. AllianceBernstein analyst Dean Rosenblum inquired, have gross margins for the second quarter of 2020 returned to their historical level of above 30% compared to the fourth quarter of 2019 when there were questions about a permanent impairment? Michael Fiddlek replied, I am expecting margin in SG&A, among other things, to be in line with the EPS guidance. I have previously noted that quarterly margins can be noisy, so it is important to look at the trajectory over a longer period of time. To address the margin pressure from last year, this is already built into the guidance for this year. Brian Cornell replied, I finished our first quarter call and I am grateful for everyone joining me. We will be in touch again in the later half of the year. Thank